And welcome back. You're still watching Closing Bell Southern Africa. And just today, Australia's central bank has joined its global peers and left interest rates at a 12-year high and signaled further tightening remains possible, joining the Fed, the Bank of England and the European Central Bank in pushing back against expectations for near-term easing and sending the currency and bond yields higher. I'm joined by Nigel Green, CEO at deVere Group, to discuss the latest global rates movement. So let's start off with the Bank of England, Nigel. They had their meeting last week, decided to keep the policy rates unchanged at 5.25%, but you had quite some words against this, basically saying that they have failed to act decisively against inflation, highlighting a continued failure to fulfill their mandate. What should have been done, in your opinion?
I think lots of central banks, as you know, have got this issue around the world. When do they cut interest rates? The reality is if they don't cut them soon enough, you crash the economy. So there's no point, in my opinion, in being indecisive. Really what they're doing is they're leaving rates at a 19-year high. That's massive. And there's no need to cause people suffering. It's time to cut, particularly in the UK, and it's time to cut now. By not doing so, they're causing issues to people that have big mortgages, credit cards, and that shouldn't be the case.
But what do you make then of inflation? I mean, the OECD came out with their interim outlook, forecasting that the UK would be burdened with the G7's highest inflation rate at 2.8% this year. And they estimate a 2.5% in 2025, very much showcasing that the Bank of England really has a tough fight ahead of them. So what would be then the way forward?
I think every government's got a tough fight. You know, we just heard the previous speaker talk about South Africa. They should be cutting interest rates. There's no doubt about it. You know, inflation is coming down, but we've got this expectation that we're going to go back to where we were 5 years ago. It's a wrong expectation. We live in a world where, unfortunately, you have deglobalization. When you have deglobalization, you can see it around the world, then you do have higher inflation rates. So we have to realize that inflation is going to be higher than the past, and there's no point in making people suffer with higher rates that are necessary in several countries around the world, including the UK and, in my opinion, South Africa.
Okay, so let's then talk about Europe, the European Central Bank. I mean, they had their inflation print not too long ago showing that France and Germany seem to be winning the battle against inflation. So is it still too early for rate cuts for them, or is it looking positive?
I mean, I think one of their issues is they've got so many different countries altogether. So it's a problem for Europe in general. It's just you've got 30 different countries in effect together, all with the same interest rate by the European Central Bank. So you've got some countries that have got high inflation, some countries that have got it under control. Reality is that in Europe overall, inflation is lower. And I think every central bank right now, including the Fed, has said, yes, we're going to cut, but not now. Are they being overcautious, and are they causing people problems by looking too far back at the data instead of looking at the current data and really seeing what's about to occur? So I think, you know, ECB can sit back a little bit, and I'm not surprised they've done that. And it's probably going to be after June before Europe actually starts to reduce. So UK should be reducing first, in my opinion, then Europe probably after the summer, and America. Will they do it in March or will they do it in April? That probably looks like they're going to be going for an April cut, I think.
Okay, so let's talk about America, actually, because the OECD also looked at their inflation outlook, basically saying that they estimate that it will be one of the lowest of the G7 at 2.2% for 2024. But we have seen the Fed very much signaling to the market that they are not necessarily going to be moving rather cutting anytime soon. I'd just like to get your thoughts in terms of what we've seen from the Fed's commentary in the latest, let's say, the last couple of weeks, as well as the outlook going forward.
I mean, it's been super interesting as a financial commentator. I mean, you're looking at it and everybody was expecting this year to have 7 cuts in interest rates in America. So that was priced in, particularly into the fixed interest market, in the bond market. And the head of the Fed, Jerome Powell, said that we're going to cut, but we're not going to cut now. It's probably going to be after March, and all of a sudden they're pricing in 3 cuts. Why? You've got a very strong labour market in America. So America's a very strong economy at the moment. So they actually, can afford, the economy's not going to crash. So they can afford to leave it a little bit longer. But also remember that countries like South Africa and many around the world, if their currency falls, so let's say in South Africa they reduce interest rates, then the rand falls, and that increases inflation. So you've got a double whammy. You've not only got less of an effect of interest rates, but you've also got the currency falling. I still believe it's better for those countries to actually start to cut, ease the burden, and actually put more infrastructure in. I mean, let's be honest, we're suffering today for problems caused in the past. So America printed too much money, the UK did, South Africa failed to invest in infrastructure, and Europe's been too rigid. So we've got the pain today actually caused by policy makers not making the right decisions in the past. They're now being, in some countries, too cautious, and I think that's causing unnecessary issues right now.
Well, Nigel, that's a very comprehensive summary there. Thank you so much. Unfortunately, that's all we have time for. That was Nigel Green, CEO at deVere Group.